Welcome to F.A.C.E, Danny.
Oh, yeah.
How are you?
I'm good. Can you hear me
Dale,
now?
Dale,
Right.
I will do you the favor of actually asking a question which is irrelevant. Hello.
Hi.
Um, did you
Uh,
happen to be colleagues with Ilias Karakitsos in the BOE?
no,
Okay.
no, no. But I was listening to your conversations and remembering the years of being in a minority of one. And eventually Gordon Brown said to me, Danny, there's only two opinions, yours and everybody else's is wrong. That was one of the great lines. Call me up and said, now we're going to have to sort this thing out. So I voted alone from October 2007. But when the Prime Minister calls you up and says that, you think, okay, I'm probably doing all right.
Yeah. Yeah, well, you're definitely your rep precedes you being here, Danny. And you and I have talked together. I can't remember when. It
Yeah.
must have been many years ago when I was on FX Street.
Yeah. I mean, we've been around, Guy.
Yeah, you and I, they can't get rid of us on FinTwit,
I know,
can they?
I know. And I like the thing you said about it's going to be the world of data. I mean, I'm a labor economist, and the data are a complete mess.
Yeah,
Pretty
markets aren't reacting to it either.
Well, here's I think the biggest puzzle. So in everything I've ever written and looked at in my life, when an economy slows, what happens is that unemployment rises and wage growth falls. So what we've got now is unemployment has risen and wage growth around the world has risen. So that's pretty tough.
Okay, so you picked a pretty interesting topic considering how euphoric the financial markets are,
Right.
Danny. I mean, everyone compares this era to what happened in 2000 with the dot-com bubble. Anything that had dot-com. This, I think, is so much different because it was pretty isolated to equities and dot-com. But this time, you can't find an asset class that hasn't appreciated. They've even had to invent new ones.
But I listen to all the commentators, and I'm an old central banker, and I say to everybody, well, there's a really simple reason for this. It's called asset purchases. $80 billion a month of asset purchases. Central banks around the world are buying assets. Why did we do it? I mean, I remember in March 2009 when we announced that we were starting to buy assets. And the reason was to raise asset prices and to encourage risk in the market. So I think all this sort of prognosticating and hand-wringing about why these asset prices are rising, I think almost exactly it's that. That was the point of it. I mean, that's why I voted for it. So I think it's not really a puzzle, and it's not really that connected to real things unless you think the reason the central banks are doing it is because of the problem of real things. And listen to Janet Yellen, listen to C.C. Rouse, and the argument is that you have to boost the real economy. What weaponry do you have? Well, you have the central banks, but now in the US you have fiscal policy moving along with monetary policy.
So do we have overkill, Danny? Larry Summers, I'm sure you know who he is. All right, I got your reaction.
I first met him in 1983 when he was the youngest full professor at Harvard, and he was a jerk then too.
You don't pull any punches anyway.
No, but the story I think perhaps we should think about is, and I think in a sense the story that I've always had in my head is that the scale of the negative shock was so enormous and huge that mostly people who argued, inflation is going to take off and so on, really didn't understand the scale of the negative shock. So if you sit in Zimbabwe, and you put all this asset, you buy all this money, and the central bank prints it all, that's totally different. And I don't think the prospect of inflation rising much. I mean, you may have some temporary things, and we'll see that. But the central bank needs to look through it. The central bank needs to look through and say, let's boost the economy and try to get the real economy moving again. And I'm a labor economist, and what you want to see is essentially a boost to people's nominal and real wages. and the Fed made an error in 2015 thinking we were at full employment, nowhere near it. So I think Larry and Olivier's arguments are tosh. I don't think we're likely to see that. And in any case, if you're a central banker, you and I could be the Fed. I mean, Jay Powell can call 3 people into his office, members of the committee, and say, right, let's just raise rates. It's not really hard. If you see inflation moving up hard, they know exactly what to do. We'll just vote for rate rises in the way that we voted for rate cuts. I voted for a 150 basis point cut, 100 basis point cut. Well, okay, we know what to do. So I just think the reality is that people have underestimated the scale of the shock, don't understand what central banks are doing, and realize that on the upside, it's kind of trivial. The downside is where all the risks are.
Okay, so do you think that through the Fed action after the COVID crash, they bought us a couple years or
yeah,
longer?
I do think so. I think that's right. But the thing I always have in my head, I mean, think about the UK. You have rates sitting at 10 bips. I mean, rates are sitting at 10 bips. And obviously there's a debate going on about whether you could go negative and where you could go. I mean, the reality is that you have to move to fiscal things, as Janet has argued, because, how far can you go? I mean, how negative can you go? I mean, I should go back. The reason we did QE in 2009 was essentially the staff were sort of estimating what should interest rates be. Think of the adjustment. Here's the economy. You adjust rates, you change rates by 25 bits. What do you do? And we had meetings where they were talking about the models were showing rates should be -4, -5. And that the reality was, how the hell can you go there? And the reason you do QE is you say, well, we can't go to -5. So if you can't reduce the price of money, you have to raise the quantity. And I think we're still there. I mean, we saw Japan yesterday at the meeting saying, likelihood is they don't think inflation is going to get to 2 for a really long time, and we're going to keep the stimulus going. And I think that's the reality. But for Larry Summers and Olivier, who in August 2008 said the state of macro is good and hadn't spotted that the US had been in recession for 8 months already, I think they're not credible sources.
Okay, so we have this K recovery, right? That's the letter everyone's using.
Right.
So is that the despair, Danny? I mean,
Yeah.
I read a little bit about your piece, and it's an interesting topic with euphoria in the markets.
Yeah.
But is the upper K that is euphoric and happy, while the bottom K, like my partner Blake Morrow said, is priced out of being able to buy a house?
Well, exactly. No, exactly.
Right.
Well, so let's go to what. So I remember Janet Yellen when at the Fed having a meeting about inequality and worrying about, we're doing quantitative easing, and obviously asset holders were hurt, but what you end up doing is you end up buying assets and helping asset holders. And I was thinking in the UK, one interest rate help is it's too low in London and it's too high in Scotland, right? So then the reality is, okay, so the market's doing fine. People are on stocks and shares and houses are doing fine. What about the rest? And I think you have to then sort of connect to, well, why was there a burst of populism? Why was there a burst of populism in the UK and in the US? The reality is it's the people without a college education. Well, what's going on with them? And there's a whole series of evidence now, driven particularly by this work by Case and Deaton on deaths of despair. But we've been working a lot on trying to look at, well, who were these Trump voters? What were these people thinking? And I've written a lot about the lack of good jobs was a really big deal. For the less educated, the quality job that was there in 1975 isn't there today. And we've documented this huge rise in what I call despair. I have a picture if you'd like me to show you.
Okay, you can.
Can I share the screen and show you?
Yeah, share. Go ahead. Go ahead and share and hit the green button.
Yeah, this is a scary picture. So this is so this is data asking folks over the last 30 days, how many of those days were bad mental health days? So this is a pretty good indicator. And if I ask your listeners, most people just say 0. So 2/3 of the people say 0. So the question is, who says 30? Who says 30 of the last 30 days, all of the last days were despairing, terrible days? And the answer is, if you look here, we're talking, so this is for less educated prime age. We're talking about 1 in 10 of whites, about 1 in 8 of blacks. And if you look at natives, we're talking, we're talking numbers in 15% or so. So this astonishing rise is a really big deal. And precisely, so think of this as morbidity. The mortality data is exactly like this: suicides, opioid deaths. If we look at Native Americans, we just had some data out which says an enormous rise in the deaths of Native Americans.
COVID.
Meth overdoses. Yeah, and of course, the same people have been hit by COVID. And so this seems like there's your K-shaped recovery. The non-college, I mean, that's unbelievable. This is 1 in 10 white prime age people who are non-college, and higher than that still. So there's your K-shaped recovery. And if you look over time, the rise over time is dramatic. So there's the K. And what are we doing about it? I mean, in some sense, the Biden, I'll unshare my screen now, but I think that's an astonishing picture. And so the K-shaped recovery, and Janet Yellen and CC Rouse are Labour economist friends. I've known them for 30 years, but they are on this one. And in a sense, the more the recovery of the top part of the K goes, what we've learned is that relative things matter, right? So the story in behavioral economics that I've worked on is that, if I see you all doing really, really well, that impacts me. So I think, I think the reality is that this is all very well, the stock market rise and the exchange rate doing things and so on, and low interest rates, and we're worrying about, stock X and stock Y. We have to worry about the fact that, 90,000 people die from opioid poisoning. Suicide rates are up. Alcohol rates are up. What are we doing about it? And in a sense, those numbers
we're sending checks.
Well, we're sending checks, but that's not solving the problem, right? I mean, if I just say 1 in 10 people who are less educated say that every day of their life is a bad mental health day. Well, and that's
maybe they're currency traders.
Yeah. I mean, remember the thing in the Wall Street crash? People did throw themselves out of windows, right?
Yeah.
I mean, that's not. I mean, in a way, what people know now. In a sense, the reality for the traders is that when a decline comes, the obvious worry is that everybody sells like crazy, and the decline is greater. Well, why? Because they know that the central bank the only show in town for the central bank is to do more QE again and rescue them. So the danger is that we then have much greater volatility in the markets, because everyone knows that the Fed is going to step in, which they didn't know in 2000.
Okay, well, let me ask you about this. We'll go to some markets. That was an interesting graph, but the recent rise in yields that we had, the 10-year go from about 0.5 to 1.5, 1 3/4, Danny. That wasn't the Fed.
No.
Remember the guys they used to call bond vigilantes? Are they back?
Well,
they're old now. They're a bunch of old men, old vigilantes.
Like us. No, I mean, I think in a sense. So I gave a talk yesterday, and I wrote a piece in the Scottish Herald, because there's something interesting in the UK. There's an election going on in Scotland, and then why does that matter? Well, because in all probability, that's going to generate a vote, probably, for Scottish independence. And the question is, well, where would the world go if you were to be independent? What would it look like? If you're not being independent, what would it look like? And the answer is that I just think this is a response to what did people call it? Knightian uncertainty. That means uncertainty that we have no history of in the past. We can't ascribe probabilities to. And the answer is that, well, looking forward, what I think the biggest deal, and bond traders, I think, have worked it out, is that, we worry about what firms are going to do, what governments are going to do, how the vaccine is going to work, how the virus is going to spread. But more than anything, I think the great uncertainty is what long-run changes in behavior are there going to be. There'll be short-run changes and we'll have a short-run recovery. But then do people stop commuting in? Do people stop going? What in the long run do they do? What proportion of the firms that have been furloughed around the world don't survive? And that, I think, means that nobody can really run a forecast like they used to. I mean, much as they were terrible, I think what you have to do is you are now in the world of scenarios, which is if people do this, it looks like this. If people do that, it looks like that. And in the end, I say the best thing that any central banker can do, any forecaster can do, is to say, it depends. I don't know. I have nothing in the past. I mean, I do a lot of this with my students. What
Well,
do
you
we
have a
know
pandemic
in
from
50 years?
100 years ago.
Well, so
that's
think,
it.
well, I think you're right. I think you go back to 1929. I mean, the reality is that the crash in 1929 started in the Florida housing market. The crash of 2006, 7, 8 started in the Florida housing market. And we have evidence from the 2018 great influenza as to what happened. But historically, I mean, I think when I listen to various people talking about what the Fed's going to do, and I always say, well, you have nothing in the last since 1945 that tells you anything in these scenarios. So I think the answer is that bond markets appropriately are responding to vast amounts of uncertainty. Because, think about you try and run some econometrics. You ain't got nothing to put in the equation. We have nothing in the past that looks like this. Banks, we don't have evidence where other banks were in negative territory. They were doing QE. We had a shock, which was, a dramatic drop in output in the space of, 1 month. And just go back to one other thing. So in relation to well-being, we have seen collapse in happiness around the world, well, measured by whatever you like, which we'd never seen before. So I show my students the 2008 crash, apart from in Greece, wasn't happiness reducing. Yeah. If you look around the world now, you see a complete collapse. I'm going to give you an example in the UK. The Office of National Statistics has asked people about happiness for about 6 or 7 years now. And the average score from 2015 to 2020 was about 7.7. The average 0 to 10, average of about 7.7. In March 2020, it dropped from 7.7 to 5.2. It's picked up a bit to 6, but we have never, ever seen anything like this. So what does it mean? Don't know. What are the implications when people are scared senseless? Don't know.
People still could have PTSD. There's variants out there, the news that we get, Danny.
Right.
So all the uncertainty.
I think that's completely right. And so the logic is, so you think everything's going to be back to 7.7 next year? Well, I don't know. I mean, I just don't know. I have no way of telling. So I think markets are appropriately, well, A, they're concerned, and B, it's hard to think that very quickly things are going to be better. The probability is things will be worse. Maybe people won't, they'll carry on saving, they won't spend as much. That'll be bad for markets, bad for output. What will the government do? Will governments bail out on these furlough schemes? So I think the answer is that, the right answer, that when you ask people on your program what's coming, the right answer you must always say to them, well, it depends, right? And the ultimate thing it depends upon is what are people going to do who are scared senseless in a way they've never been scared senseless before? Will they remember that? And I think you said it well. Chances are they will. And that, I think, is a really crucial thing for markets to hear.
Okay. When we look at these markets here, Danny, what is your impression about all the new types of instruments and ways to invest, SPACs, NFTs? People are just buying. Speculation, I think, is running rampant. I've never seen GameStop, the Reddit people, this type of, euphoria in the markets. You talk about people being unhappy now, Danny. What do you think would happen? Like we had that guy blow out $5 billion in a couple of days in his hedge fund, and that's during an up market. What would happen if a bear market ever appeared here in global bourses, and people aren't happy now with at least cosmetically things looking okay? What's going to happen if we go through a period of asset deflation?
Well, I don't think the word's if, it's the word's going to be when.
Okay.
I mean, obviously,
the art of it is when.
Yeah. Well, the art of it is obviously the timing, but the problem is a lot of young folks have not really, they have not experienced the downturn. I mean, obviously, go back to what I said. I think people are aware, and in a sense, the Fed has to deal with this prospect, which is the Fed's the backstop. The Fed's going to rescue them. And I think that's obviously something we need to think about. But clearly in a, day trading's fine in an up market, which is sort of what you said to me, right? Yeah, anyone, you have a monkey throwing darts at a dartboard and they can do fine on an uptick. I mean, I think the answer is that if we look back, and I've done this a lot with my students, the hardest thing of all is to pick a downturn. So think everything's rising steadily. So agencies like the census and commerce and in the UK, the Office of National Statistics, they basically just forecast things as a steady trend up. It's very hard to pick a downturn. And actually you often just get that in the revisions. So I think that's the big worry. And I think, in a sense, somebody like me, I mean, I remember, let me tell you a story about the seriousness of a downtick. And I actually interviewed Alistair Darling. There's a great story. He was the British Chancellor of the Exchequer. And he tells this story, which was that he was sitting in Paris in a meeting on the 7th of October, 2008, sitting in a meeting of the European finance ministers next to Christine Lagarde. And his assistant came to him and said, "You've got to take a phone call." And the phone call was from Tom McKillop, who was the chairman of RBS. And he said to Darling, "I can't make a payment." And Darling said, "Well, how much?" And he said, "About $75 billion. And he said, "Oh my goodness." And he eventually goes back to London and he says to his staff, what if I don't rescue? And people didn't know this. So this is what happens in secret. You didn't know this for years. And he said to his assistant, "So what if I don't rescue RBS?" And his assistant said to him, "Well, there's a prospect that every credit card in the world and every cash machine in the world tomorrow stops working." And Tim Geithner, Dartmouth grad, came to Dartmouth and said, on that day, the world sat on the edge of a precipice. And I think, and it was Armageddon. And so then the next day, they rescue RBS and 7 central banks in the world cut rates together. But the reality is that people are not aware. People are not aware of how close the economies can come. Just think about that day. So that's the day. Okay, Lehman Brothers failed, but the lack of failure of RBS was crucial because it's the largest bank by assets in the world. So people should not underestimate the possibility that banking crises come. And if banks start to fail, the global economy collapses. And I think people underestimate the fact that such things can come very quickly. They can come rapidly, and the economy can be at the edge of Armageddon. I mean, go back, every cash machine in the world and every credit card, basically the prospect was if they didn't rescue RBS secretly, and you didn't know it, market traders didn't know it. So imagine what might have happened. And the reason, in a sense, that the euphoria has to be thought through is that came, I mean, it was not entire, well, probably if you look back, people were not aware of it. So I think being not aware and also understanding that when downturns come, central banks and policymakers know things that markets don't know. People therefore have to be wary that what goes up will come down, and it usually will come down by financial failures.
I've interviewed quite a few people that have that concern about the Italian banking system that, and maybe, why do you think Draghi is taking the lead in Italy, Danny?
I mean, in a sense, so I would go further, and I think you were very spot on to say that. So think about, so when the housing crash comes in the US subprime, turns out that the Landesbank in Germany fails. Well, the reason it was set up to go and build public sector stuff in East Germany. And then we get to the early 2000s, it's like, got money, so let's go and invest in housing in Detroit. So the collapse of the housing market in Detroit brings down a German bank. An Italian bank fails, and every other bank around the world is linked to it and goes with it. And I think that's the big part of it, which is that all these banks are linked together. I mean, the insight that I had, in a sense, that other people on the Bank of England didn't have, was that, sounds crazy, I had meetings of my students when I was sitting in the bank. I had meetings of my students who worked in Canary Wharf. And what I discovered very quickly was that actually the banks that they were working for in Canary Wharf were exactly the same banks that were sitting in Wall Street. They'd just come over for 3 months. And I very quickly realized, and one of the big reasons I started to vote for rate cuts was that it looked to me that how can a banking crisis in America not spread to the United Kingdom and elsewhere? I mean, Mervyn King had spent a long time saying that the two economies were decoupled, and I kept making speeches. That was the most ridiculous thing I'd ever heard. So given that, given the Italian banks are also trading with American banks and British banks, and they're all linked together, the reality for the US economy is you have to care about Italian banks, right? You care about Japanese. I mean, here's another one. I was sitting on Bloomberg on the night of the Brexit vote.
Okay.
And just as we actually had to explain to people what a Sunderland was. And a Sunderland, which was a place in England, and the vote suddenly said that they were going to go to Brexit. And we watched in China and Japan and Australia and New Zealand as bank shares started to move on the basis of a decision made in Sunderland. So I take the view, I mean, your view exactly, you put Draghi in there because America cares about Italian banks and has to. And I think that's the thing. I think people forget that everything is linked together. And what happened on October the 8th was that 6 of the world's central banks operated together because we knew the global banking system existed. So you had, the ECB, the Bank of England, the Fed, the Bank of Japan, the Swedish central bank, and the Swiss central bank. And then the next day, the Chinese central bank moved too. So I just think we're in this world where, one down, all down. And I think people have underestimated that.
Okay, we here in the U.S. we're having trouble in the repo market, and that wasn't Italian banks, right? People being not able to trust to lend and transfer money to other U.S. banks, and so there are a lot of structural issues that are still out there. Danny, let me wrap it with what was your view on Brexit, and is the pound going to become a safe haven currency because they're not going to be locked into the euro here? Maybe they benefit from this.
Well, I mean, obviously, I thought that Brexit, the deal that was done, looked to be a disaster, and that's appeared to be unscrambling. I mean, almost inevitably, what it's generated. I mean, I'm now attached to the University of Glasgow. And the debate is going to, I mean, we should talk after May 6th. We're going to see this vote on May the 6th. Right. I suspect it's going to be a big move to support voters for independence. And essentially what Brexit has done is it's pushed out Scotland. And if Scotland goes, it'll probably pull up Northern Ireland with it. Northern Ireland, now there's almost exactly a united Ireland. And obviously the problem right now is to separate out the pandemic from Brexit, which is still sort of disentangling. It looks that particularly Europe is in some trouble. But I think once again, it's hard to separate the things out. But it certainly looks, when you look at things like the fishing industry and shellfish and all these issues about how you're going to deal with Ireland and the bureaucracy. So it certainly looks that it's a major issue, and I think it's going to generate a vote for Scotland to be independent. And conversations like Alex Salmond, ex-First Minister, yesterday came out and starts to talk about not only should Scotland become independent, but it should have an independent currency, separate currency. They might call it the Scotty or the Kilty or something. But we're in a world where Brexit has basically pushed countries apart.
Well, you could come up with a crypto like Dogcoin and use that. So, Danny, take a minute or two and give me a thumbs up or thumbs down on crypto. And will central banks, are they allowing this experiment in cryptos to happen so that the public becomes comfortable with the concept so that they could have their own?
Well, it certainly looks that way. I mean, it certainly looks that they're going to explore it. I mean, in a sense, I think one of the big arguments, I think, is this, which people may not have thought of. I mean, if you have that, you have cryptocurrencies. I mean, in a way, you generate yourself a new weapon. Think about what the Treasury has done to do its stimulus. People who filed with the Treasury got an account on hand. You can put money into it. In some sense, that will allow the central bank to have another weapon, which is they can, there's this cryptocurrency and everybody's got a record. The central bank can put money in people's accounts. The worry is it can take money out of people's accounts.
Right.
But, I mean, I do think that. I think, we're seeing people now, we're seeing central banks starting to think about what this means. I mean, it obviously relates to the discussion about, you know, should you have real currency? I mean, I'm a professor at Dartmouth, and as far as I can tell, not a single student ever has a dollar bill in their pocket.
Yeah,
ever.
more on cash.
No, there's nobody. I mean, I sometimes say in my class, I say, because I quite like to take a dollar bill out and look on it, because, you know, now we can look at which of the banks. And you open it, it's got Dallas Fed. And I say, how many people in the class has got a dollar bill? And there's not a single person, not a single person. They pay for everything with bits of plastic. So I think the answer is that, you know, we know where this is going. It's just old guys like me. I'm the only one who pulls out a dollar bill. So I think the answer is that in a sense, it's the inevitability, right? I mean, they go and buy a cup of coffee, you know, $2 cup of coffee they pay with plastic. Whatever. So I think
you know, there's COVID. You can get sick handling cash. They're using COVID for an excuse for everything.
Exactly.
Danny, you know, it really was great getting back together with you. I don't want to let this kind of time pass again. And I know you're a big fisherman.
I'm a snook guy.
Yeah, I saw that. So, you know, a priest once told me when talking about changing people's minds and converting them, that first you catch the fish, then you clean it. Is that true?
Well,
because some people try and convert the fish before they catch them.
What I do is I release the fish.
Oh, okay.
I always do catch and release, because I live in, I'm in Sanibel Island in Florida. I live in a fishery, and I take the view, this is a good way to think of. So I always release it, hoping next year I can recatch it and bigger. So think of the market. You don't want to go nuke it, because actually this thing might have a really strong rate of return next year. Here's another story to like. But look, I always tell this to my students. So snook are all born male, but as they get bigger, they become female. So female snook are smarter than male snook by definition, because the dumb ones are dead, right? So
the smart ones became women, female.
Exactly. Stock pickers, right? But I think this conversation has been a good one, in the sense that I think somehow people have not understood quite what central bankers like me saw. So the thing I would sort of say is that we saw this horrible shock, much greater shock than anybody saw. And we went to the edge of Armageddon. And I think that explains why Larry Summers and Olivia Blanchflower are wrong. They didn't really see it. They weren't sitting in the room. But those of us who were, Janet Yellen, Bernanke, and me and others, we just saw how close the world came to Armageddon. And I think the reality is that to understand what the central banks and Janet Yellen and stuff are going to do, they're going to overcook it if necessary, because they're too afraid of undercooking it.
Yeah, and wasn't that fantastic how they, after Paul tightened in his first year as Fed chairman, that both Bernanke and Yellen, they had a meeting, they held hands and sang "Kumbaya," and he changed his mind.
Well, I go back. The great thing about Janet Yellen and C.C. Rouse, they're labor economists and they're data people. Start where you started. I was first called by Janet Yellen. She called me up when, I think it was in 1993 or 4. She was governor at the Fed. She called me up and she said, "Danny," this is a bit technical. She said, "Danny, your wage equations are better than ours. Can you come down and talk to me about them?" And so I went down to the Fed and talked to Janet Yellen about the data, right?
Yeah.
So Janet's a data person. There's a great story of her husband, Nobel Prize winner, and his prize-winning speech, he said, "I'm really pleased to win this prize. I should just tell you, I'm the second best economist in my household."
Yeah.
So, so you've got data people. You've got people who actually understand how to analyze the data and understand what they don't know. And I think that's where we are. A lot of this stuff we just don't know. It depends, remember? It depends.
The older I get, the more I know I don't know, Danny. So,
I agree with that. Think about what undergraduate education's about. After 4 years at Dartmouth, you realize that you knew less than you did when you came, right?
Thank you so much Thank you so much for your time. I would love to audit one of your courses, Danny.
Oh, yes.
And really appreciate you coming here, and would like to have you come back and let's see how things are unfolding here in the world economy.
Well, invite me, and I think we're going to see this interesting debate in Scotland. I've got students, so I've got students actually working on the Czech Republic and Slovakia. If if you think about if Scotland's going to separate, what's the history? So Czechoslovakia is an example where two countries split apart. Let's think about what would happen. And markets, it's going to be a really big deal. Should they get a central bank? Should they get their own currency? What would it look like? How will it affect, how will it affect the pound? Because if this vote on May 6th happens, this is going to impact the pound, I would thought.
Okay. Let's wrap it with some pound volatility coming up in May. Danny Blanchflower, and you could follow Danny on Twitter. Important guy to follow. You could follow him at D, and it's _ Blanchflower. Danny _ Blanchflower. And thank you, Danny. Look forward to doing this again with you, my friend.
You.
All right.
Bye.
That's a wrap, everyone. Remember, don't just count your pips, count your blessings. We'll see everyone tomorrow. And good hunting the rest of the day. Everyone's thanking you, Danny. You're a hit.
Good.
All right.
I'll get the chat.
All right. See you, buddy.
Thank you.
All right. That's a wrap. And you could join the team for Morning Edge in 9 minutes. Adios, everyone.
Yes, all.
Thanks again, Danny.
Sir.